I'm Calvin Koo, and this is your March 2023 crypto update. As a reminder, my thoughts and comments are strictly my own and not that of my employer. Nothing I say is intended as legal or financial advice. Over the last few weeks, traditional banks around the world have been facing stress, including a few linked to tech and crypto companies. Indeed, a few of the crypto industry's most used banks, especially in the US, have gone under. Now, overall, although this is not strictly a crypto story, it reminds many of various debates about the level of and what types of regulation are needed around financial services and financial services related companies. And it asks questions about how effective those regulations are and whether changes are needed. As viewers will know, regulation has been an ongoing debate in crypto across jurisdictions around the world. Let's start this month by taking a look at the latest on that front. Now, a common perception in the crypto world is that many key jurisdictions are cracking down or tightening policies and laws over crypto in light of crypto winter over the last several months. This includes the US, which has been bringing enforcement actions against major industry players. Some skeptics of government policies think the latest activity on banks that had crypto clients further supports this view, though others will say that's reading a little too much into a fast-moving crisis decision-making situation. In contrast, the crypto community in Hong Kong has been in an optimistic mood over the last few months, ever since the local government repeatedly signaled support for Hong Kong to become an international crypto hub. This support was echoed again just this week by the Hong Kong Secretary for Financial Services. A key part of that drive is amending relevant laws to have the local securities regulator empowered to regulate crypto exchanges. This is without necessarily finding that specific or all cryptocurrencies are securities. It's simply that the government found that the existing securities regulator would be best placed to also regulate crypto exchanges, since the local regulatory mantra is same activity, same risks, same regulation. This effectively compares traditional financial support activities to those in the crypto sphere and then regulates them in the same way. In late February, this securities regulator, which is the Securities and Futures Commission, or SFC, released its consultation paper on the proposed regulatory requirements for virtual asset trading platform operators licensed by the SFC. Now, it's a 361-page document, so credit to those commentators and professionals out there who've already helpfully summarized key points. Among those are the following observations, which I've collated. Exchanges likely should have two licenses, both a securities license and a specific virtual asset service provider license arising under Hong Kong's anti-money laundering ordinance, which we've discussed previously in this series. Now, technically, the securities license may not be needed in all cases, but the SFC says that since virtual assets may evolve and thus impact whether it's a security over time, all exchanges are encouraged to be dual license holders. Like traditional IPOs, there are now proposed detailed requirements for token listing governance, due diligence, and disclosure requirements. There are also provisions about streamlined listing, insurance, and setting aside compensation funds to protect assets under custody. The biggest buzz is about opening the door to retail investors, requiring enhanced customer onboarding requirements, including on risk tolerance and profile. Platforms must place limits on crypto exposure based on that assessment with regular reviews and updates. Also, trading will be limited to, quote, specific token admission criteria, namely large cap virtual assets included in at least 2 acceptable indices by independent index providers. With that, retail investors can trade on licensed platforms. Now, this is notable because under the existing opt-in regulatory regime in Hong Kong, only professional investors were able to trade. Now, given the understandable caution with which many governments around the world are taking on crypto trading and investments so as to protect consumers, there's been a concern that places would crack down on retail trading, in a sense, protecting people from themselves. Hong Kong's approach is to allow the freedom to do it, but with the expectation that disclosures will be better and the products limited to those that are comparatively less risky given their capitalization and placement on multiple indices. Doesn't make risk zero, and that would only be achieved by a ban. But it does make it more like traditional securities, where people are expected to take calculated and informed risks. As with traditional securities, people can still criticize the amount of and manner in which that information is disclosed and shared, as well as the independence of third parties relied upon to give credibility to entities or products. But again, Hong Kong's approach to balancing these issues is embracing new technology and opportunities with consumer protection requirements. And this has led to that same activity, same risks, same regulation principle. Open questions still remain about derivatives, lending, and leverage services, but the community has welcomed these concrete steps towards clarity. The consultation period closes at the end of this month. Meanwhile, in the US, a flurry of stories about the ongoing debate about whether cryptocurrencies are securities. Last month, the US securities regulator, the Securities and Exchange Commission, or SEC, proposed a rule that reportedly could make it harder for asset managers to invest their clients' money into cryptocurrencies. The SEC's proposal would expand the types of assets for which investment advisors must use qualified custodians, and it also creates new requirements for those qualified custodians. The requirements might make it difficult to apply to crypto assets, given the nature of cryptocurrencies. As many of you know, anyone with the private key for a wallet can transfer the crypto in the wallet. The SEC notes that because of that feature, it may be more difficult for a custodian to demonstrate that it has the necessary exclusive control of the crypto. Without being able to demonstrate that control, there may be no way for it, and by extension the asset manager, to hold the relevant crypto. In effect, this might not only limit how asset managers can handle their clients' crypto holdings, but also the absolute number of available custodians willing to jump through these additional hoops. Skeptics of the US's recent moves, which are perceived as anti-crypto, see this as just another step to cut off crypto's links to traditional financial tools and markets. Others may say that this is just a way to regulate the market and the product as well for the protection of consumers and customers. Might this be the US's own approach to same activity, same risk, same regulation? Maybe, but arguably it's not quite the same given crypto's unique technical features, which mean in practice, those proposed rules do not result in the same regulation as traditional financial products. At least that's what the contrarian view would be. The comment period is now open, and later this year, the SEC is expected to begin drafting the final rule. Now, staying in the US, but moving to the state level, New York State's Department of Financial Services announced on February 21st unspecified enhancements to its ability to detect insider trading and market manipulation associated with regulated entities' exposure or potential exposure to virtual currency wallet addresses. The regulator's superintendent said that, quote, "These tools will help us combat financial crime and fraud, hold regulated entities accountable, and further strengthen our national leadership in virtual currency supervision," end quote. Again, the specific new technical capability was not revealed, but as those who are involved in crypto tracing and recovery may be aware, there's always a cat and mouse evolution in technology and associated tools whereby governments and civil tracing professionals are constantly reworking their tools to keep up with the latest techniques by bad actors. Moving on, we've often spoken about the Financial Action Task Force's guidance on virtual assets, which is an influential policy guide for many jurisdictions around the world, particularly on anti-money laundering regulations and best practices. On February 27th, FATF published a report on money laundering and terrorist financing in the art and antiquities market. Now, this is, as it suggests, primarily about art and antiquities, but there is a discussion about non-fungible tokens as well. Now, the technology underpinning NFTs, non-fungible tokens, is not just about art. NFTs can go beyond that, particularly as an authentication tool, for example. But the general popular focus on NFTs over the last couple of years have been in relation to art, hence FATF's need to include it. Indeed, this publication says, quote, "The sale of digital works of art, especially those associated with NFTs, has steadily increased over the past few years, rising massively in 2021. It was 44.2 billion in 2021, compared to only 106 million in 2020. Those are US dollars. For those monitoring, the NFT market fluctuated significantly over 2022, but FATF says they continue to present money laundering vulnerabilities. FATF identifies these vulnerabilities as including, quote, "the ease of transferability of ownership, the absence of a need to physically transfer the art, the possibility of exploiting the flaws in smart contracts used by an NFT platform in thefts or other illicit activities, The lack of monitoring of NFT wallets and the concealability of underlying virtual asset transactions, the inherent exposure to online theft, wash trading, and the range of market participants that facilitate their exchange, end quote. The report goes on to say that said, some of these vulnerabilities may be mitigated by developing policies, mechanisms, and operational techniques to improve the ability of law enforcement to track the transfer of NFTs between parties in some cases. The report also gave 2 short case studies. In 2021, a wallet holder sold a single NFT from a popular collection for several €100,000 worth of virtual assets. Upon investigation, it was found that soon after the sale, the buyer wallet sent back the NFT to the original owner's wallet address. The same wallet then subsequently placed the NFT for sale again for an even higher price. The movement of the NFT between wallets after sale and the increase of the sale price was indicative of wash trading between the same buyers and sellers and purposely inflated the value of the NFT. In another case, a self-taught digital artist transferred several million euros from his virtual asset account to a personal bank account, claiming that the source of funds was the income from selling digital art in the form of an NFT. The artist's criminal past and links to organized crime raised suspicions, as did the absurdly steep rise and their similarly rapid decline afterwards in the commercial success of the artist. In a period of 1 month, the individual rose from a digital art enthusiast to one of the most successful NFT artists. Multiple red flags appeared upon analyzing the NFT transactions. The red flags indicated possible wash trading, inflated values of art, as well as the use of different virtual asset services that reduce the traceability of transactions. The FATF report ultimately concluded that marketplaces for NFTs represent an emerging vulnerability, though few cases had been detected so far, and in many jurisdictions, the market is not regulated or supervised. FATF says it'll continue to monitor. Finally, a few short updates from around the world. The Indian Ministry of Finance has published a notice listing certain activities that fall under the Prevention of Money Laundering Act, including the exchange, transfer, safekeeping, and administration of virtual assets. This means that financial institutions must keep a record of all transactions for the last 10 years and verify client identity, all in line with best practices around the world. This week, Taiwan's financial regulator, the Financial Supervisory Commission, said it would supervise cryptocurrency payments and transactions. Reportedly, the head of the regulator told the legislature that the regulator was building a crypto framework to cover rules and policies, including segregation of customer assets from company funds. The Financial Services Commission is not tipped to regulate NFTs, however, as that's likely to fall under the purview of the Ministry of Digital Affairs. A few highlights from Chainalysis's annual crypto crime report. The 2023 version was released last month. The report says the following. Despite the market downturn, illicit transaction volume rose for the second consecutive year, hitting an all-time high of $20.6 billion. This is a lower bound estimate as the figures will grow as Chainalysis identifies new digital addresses associated with illicit activity. 43% of 2022's illicit crypto transactions came from activity associated with sanctioned entities, in a year when the U.S. Office of Foreign Assets Control launched some of its most ambitious sanctions yet. We've covered a lot of those in this series. Transaction volumes fell across other more conventional categories of crypto-related crime. Chainalysis suspects that this may be due to less revenue during bear markets. Overall, the share of cryptocurrency activity associated with illicit activity rose for the first time since 2019, from 0.12% in 2021 to 0.24% in 2022. That said, it's still below 1%, and the overall trend, despite last year's jump, is a downward facing trend. That's it for this month. See you next time.